from our perspective, a lot of this post-crisis regulation has actually been quite aligned with creditors' interests. So if you think about higher capital standards, higher liquidity standards, better governance, or rules requiring better governance, those are all things that help the credit profiles of banks. And in fact, I'd say right now we're looking at banks, they have probably the best capital levels, the best liquidity levels, very strong governance, the best we've probably seen in quite some time. And I think things like stress testing and, most importantly, resolution planning have really done a lot to improve the safety and soundness of the banking system, and I think has given the market a lot of confidence in banks. So there is a risk, I think, from our perspective in terms of deregulation, and there's been a lot of talk about, there's less credit availability, but our study has shown that actually loan growth post-crisis, if you look at the 2011 period on, has really outpaced GDP, and in some asset classes has been, multiples of GDP, and so very healthy growth. And the one factor that is sort of holding back loan growth in the post-crisis period has really been the fact that the housing sector, because of foreclosure, has taken a longer time to recover. So actually loan growth's been pretty good from our perspective. We look at earnings, which is the one thing I think where banks haven't fully recovered. That's partly been because of the low interest rate environment that we're in, as well as I think structurally regulation has probably taken something out of bank earning profiles. We've spent a lot of time looking at the Financial Choice Act. We've spent a lot of time looking at the Senate bill. Those are all things that we're paying a lot of attention to because I think you're right. From a big bank perspective, they're probably not going to get a lot of relief, and the smaller banks will. But we view that with some caution because I think if you look at, for example, like a 10% leverage ratio, which is a simple, I know that was part of the original Choice Act. When we did an analysis of all the banks that failed between 2007 and 2011, and it was quite a lot of bank failures at the time, these were mostly smaller institutions, 35% of them failed with a 10% leverage ratio. So you have to be careful to make sure that that's, you still have to look at risk-based measures, and I do think from a bank creditor's perspective, those prudential requirements are quite important. And so we are looking at that with some level of caution. I think we will acknowledge that regulation probably has had some unintended consequences a little bit differently than some of you may be thinking about. There's been talk about the liquidity in the bond markets changing because banks have not been, the broker-dealers, they've not had as much inventory. But I think from our perspective, we look at that and we say, there has been the risk that some bank management teams are over-relying on CCAR as opposed to doing their own. I mean, they're all doing their own stress tests too, and we actually think that's really important. But to the extent that they over-rely on regulator stress tests as opposed to their own, we also look at whether or not, these management teams are going to start dividending out a lot of capital. And at this time in the cycle where, asset quality's been at an all-time peak, the credit environment's very benign, and if you start to lower capital requirements, then, I think the timing could be an issue. I'll say this, I think we can acknowledge, and I think even bank creditors can acknowledge that there were elements of the rules that were not tailored for specific types of business models, right? So you look at the trust and custody banks as an example, and you're using certain risk-based capital rules for those institutions, which, they're very liquid, right? And so then you're penalizing them for being very liquid by forcing them to hold extra amounts of capital against that liquidity. So those are areas where we think that, from a creditor's perspective, it might be more neutral if some of those changes were to go through. I think the Volcker story is one that's been talked about a lot, and, from our perspective, as long as the spirit of the rule is maintained so that banks are not returning to proprietary trading, I think from our perspective, that's also not a negative from a credit perspective. And we do think that there's been a lot of money that's been spent on compliance, and we've heard from banks that, some of their submissions are 10,000 pages long for one Volcker submission to prove that they're not proprietary trading. And so it seems to me like those are areas where, yeah, that's neutral to a credit profile and actually might help their earnings a little bit, which could be, and we are trying to balance the fact that at the end of the day, as bank creditors, your first line of defense is shareholders, right? And so shareholders do need to have some return. And there's this big question about, and that's the lagging bit is the earnings story. And so if shareholders aren't getting some return, then are they going to be there in a crisis when banks need to raise capital and creditors need them to be there to raise capital, right? So there is a bit of a balancing act. But it's if there's too much capital return. And I do think that when we look at the rules, there is a swath of banks that have the opportunity now to return a lot of capital to their shareholders, which from a creditor's perspective is negative. But ultimately, I think the ratings impact will depend on how each individual bank responds to it and whether or not they go, full bore into returning capital or if they maintain relatively conservative profile.
So you don't think if 2155 passes as is by the House and is signed by the President, that's not necessarily ratings negative for...
No, I think we have to wait and see how the banks respond to it. So I think different banks will respond in different ways. Some will be more conservative. And I do think, I think most bank management teams have acknowledged that stress testing has been a good discipline. And quite frankly, it's a sunk cost, right? They've already spent all that money. And it has, in many ways, improved the governance of the banks. And so maybe they don't need to do all of the work around it. But I think many would say that it's largely been positive.